Okay, so welcome everyone. We're here today with a very special guest, and um, this is really a treat for me, and I'll tell you why in just a second. But let me just first tell you about Stan Weinstein, who's the author of this book that is a classic. It's called Secrets for Profiting in Bull and Bear Markets, and it's one of the first books that I read when I first started trading many years ago. And Stan, let me just introduce you real quick. I'm very pleased that you can be, and honored that you can be here. Thanks for showing up.
Pleasure.
So Stan, we were just talking just before, and in 1990, I went to a conference in New York City, and I had the pleasure to meet Stan for the first time. And we actually had lunch together, and I doubt Stan even remembers me because it was so long ago. I was a much younger guy, and I actually had hair then, right? You said your hair was actually black, right?
Back in those days.
So a few things stuck out when I met Stan. First of all, he had a necklace on and it said Stan in diamonds and gold. And I was like, this guy's a rock star. He looked more like a rapper. So Stan, do you remember that?
I do remember that. It's in the rearview mirror.
No, you were awesome. You were so colorful, and you were such a pleasant, nice guy, and you're so willing to share information with me, and it was really awesome. And I left there, with some things that we're going to talk about today that really made an impression and ended up becoming the cornerstone of what I start with for picking stocks, and that is with stage analysis. So we're going to talk about this stage analysis and the basics of what now is the stage 1, 2, 3, 4. I call it a confirmed stage 2 uptrend. That's what I'm looking for. Stan, I want you to talk a little bit about this, because this is really you're sort of the I haven't didn't find anybody prior to you that was talking about these 4 stages. To me, you're the one who came up with it. Maybe you followed somebody and read about it somewhere else, but I don't know of that. I just know of you, and that's where I learned about the stage analysis. You started off using the 30-week or the 150-day moving average as sort of the price being above and having that trending up and down. But I've understood that you have changed over to the 200-day now. Is that true?
Right. First of all, yes, I came up with the concept, and I'm always willing to give credit. Originally, I started out reading Edwards and McGee, which many of us did, and that got me going market-wise, technical analysis, etc. But they didn't use moving averages. Then I started fooling around moving averages, and it almost became like an aha moment where when I started looking at the charts, as people get it wrong, Bob, they think stocks suddenly go from the outhouse to the penthouse overnight. Not true. Just like a house needs to build a base and a foundation, so too the stocks. So as I looked at charts, while it isn't 100% perfect, I saw the pattern repeat over and over again, that after a stock has a big decline, it forms a nice base, but initially the base may still be forming well below its 200-day. It doesn't matter. I used 150, now I use 200, but let's just stick with 200. It could be well below its 200-day moving average, so it's early in the base. You've seen the low, but it isn't ready to rock and roll. Eventually, let's talk in numbers. Make believe the stock fell from 25 down to 8. And then it went sideways between 8 and 10 for a lot of months. But if the long-term moving average is still at 15, it's early, preparatory in the base, but you're not ready to rock and roll yet. Eventually, you'll see it becomes like an aha moment where now the 200-day moving average has fallen close to that base, let's say at 10.5. So when it breaks out above the resistance at 10, and then it moves above the 200-day moving average at 10.5, you've completed the stage 1 base, you've moved into stage 2. That's the ideal time for me to do buying, both from trading and investing. Then let's make it easy. Let's say in the next several months, it's not going to be straight up, but you have a lot of advances and little short-term declines on the way to 20. Here's where I integrate a 50-day moving average, which was like the 10-week moving average I wrote about in my book. As long as the short-term corrections are occurring above the rising 50-day MA, you may want to take a few chips off, but it's basically a fine stage 2 stock. Eventually, you'll move into stage 3. Now, this is interesting. And again, it's not perfect, but it's amazing how time after time you see this repeat. So often when you're in stage 1, the news is crummy. It's lousy news, but the stock is no longer going down on the news. That is a tip-off to us that the news, bad news, has been discounted. Conversely, now as you move up into stage 3, there was a reason why the stock went from 8 to 10 up to, let's say, 22. Some good news came in, earnings, whatever it is. Now the stock rolls over and it's no longer rising and break out to new highs on the good news. This is when people make a lot of mistakes. They'll read in the Wall Street Journal or here on TV, there's great earnings, and they run out and buy it. The stock is being distributed on the good news. And now it's the mirror image of stage 1. We roll over, let's hypothetically say it goes between 20 and 22. You're rolling the top. The 200-day moving average comes near 20. You eventually break below 20. You've now gone into stage 4. I don't care what the fundamentalists say. I'm a seller. You've started destructive stage 4. And you'll see this pattern repeat over and over again throughout history.
So this concept is so important that it's, like I said, it's literally the cornerstone of what I call it non-negotiable criteria. And Stan, you don't know much about probably what I do, in depth at least. But what we found, and I went and, of course, as the years went on, we got computer power and we were able to go back and do factor modeling and go take a look at what the big winners looked like and what characteristics they have or had. And what we found is that 98% of the big moving stocks, that entire move is above the 200-day moving average and is in what we call a stage 2. So it completely confirmed what your work was saying when it was much harder to come to those conclusions when you were doing that. So I added a few criteria to it. There's some relative strength criteria as well, but I do use the 200-day. I actually use a 150 above the 200-day. It's just to confirm that you have the trend moving up and it's confirmed. And I want to see the price above it for several months, and also the 200-day in an uptrend for at least a month or two. So I have some additional criteria. Does that make sense to you?
Well, you're spot on. I got to tell you, we'd be great teammates together. You've got it. And to me, sometimes I've seen some people, I go in their office and I see like their charts look like spider webs because they have so many moving averages on it. It's ridiculous. But I keep it simple. A 50, a 150, a 200, done. The other thing, because I know you guys are very successful, another thing that I think is an important criteria, when you break out, I always wrote in my book that it's not that all breakouts are not of the same quality. It's just like different grades of A's. So you see, like if the stock breaks out and the volume is just fair to middling, yeah, you may make a few bucks, but that's not going to be one of your big winners with the tiger in the tank. The really big winners, I'm sure you guys have seen this in your studies, when the stock breaks out with a tremendous increase in volume. For me, ideally like to see at least 2, preferably 3 times normal volume on the breakout. Historically, that's another, as far as I'm concerned, important criteria. And if you do your work, which I'm sure you've done, you'll see that those are the stocks that aren't just, so advances. Those are the really giant winners, the ones that have a tiger in the tank.
Right. And what I was talking about with non-negotiable criteria, and everybody, we went through this in depth during the section on trend, but this is where I start. I won't even look at a stock if it's not in that stage 2 uptrend. It never even gets in front of me. Like I don't even have a chance to make a mistake and buy something in a downtrend because my computers are set to cut everything off and only look at those stocks. As a matter of fact, in MarketSmith now, in the screening program MarketSmith, they have my trend templates in there. There's a little Miniarווni file, and they have a couple of trend templates. So you can just click on it, and you can start your screening with only stocks that meet that criteria, and then you can add criteria to it. But now you're only looking at those stocks in uptrends. You
guys are terrific. I got to admit, I'm of a different generation. You have the advantage on me. I have staff that knows my criteria, and they'll kind of like the minor leagues and major leagues. They'll bring me things they think fill my criteria, and I go from there, but I don't do it just by computers. Again, I'm not knocking anybody else's method, but for me, there's a certain feel, and you can't inculcate, though you're right about the computer ferreting things out, I think there's a certain feel that can't be put into a computer. And this is why, this is going to probably sound crazy to you, but in the old days, I used to love when I did, and then we had staff do, charting manually. I'm telling you, as you plotted the chart, you actually got a better feel. And it was only my wife, much later on in the late 80s, going into early 90s, that got me to finally switch over to computers. But to this day, I love looking at a hand-drawn chart versus one that's the computer, blue, green, red, that it'll tell you the same thing, but I'm telling you, there's a gestalt feel to the hand-drawn chart.
Well, you're 100% right. And just so you know, computers are just the very beginning that sort of narrow the stocks down for me, but I'm charting everything by hand. And I know I may not have been in the market as long as you, but I go back far enough where we did not have, and I certainly didn't have the money in the beginning too, even when there were charts, but we didn't have any charts. There was no computer programs and no internet and none of that, but not even charts. In the very beginning, I was hand plotting the charts by hand on graph paper. And then after that, I don't know if you remember, do you remember Mansfield charts? I think you use Mansfield in your book, right?
It's in my book.
They were out of New Jersey. And I used to get them mailed to me. And, they weren't the best charts. They were little tiny charts and you can barely see them. And they had the on-balance volume or something in them. So I started with those, and then I started getting daily graphs. And even then, they would only come weekly. And then you'd have to update the charts all throughout the week. And I would just plot them and put in little hash lines of where the price was. And I can only follow a handful of names that way. So,
Bob, I feel when I look at you and talk to you, I feel like I'm looking in the mirror, because this is exactly, a lot of people think I'm nuts. This is exactly what I feel when you actually do the chart and you plot it. Didn't that give you a feeling like, oh, I really like today's action? Oh, that's a little worrisome. You could get a feel that didn't come off of a computer.
I tell people all the time, first of all, they used to call it back in the old days, in the Jesse Livermore days, they would read the tape and they would call it a ticker sense. And you get a feel of the tape. And there's nothing like doing that work by hand, and you live it. You live through every price movement. Even when, before we had real-time charting on the screen, I just had quotes, and I would watch the bid and ask, and I got so good at watching the bid and ask, I could know when a stock was going to move just by how it was trading and the speed. I see the lights start flashing quicker, and it was really something else. And just like you're saying, you really get that feel. And I think that's what's lost right now. It's great to use computers and it's great to use technology, but this is the main thing that I try to tell everybody. This is an art. And if it wasn't, Stan, imagine if you could take everything. What would happen if we could take every variable and we could put it into a computer and figure it all out? There'd be no opportunity anymore, right? Everything would be efficient.
Again, you and I are so simpatico, because when I was young and foolish, I used to when I went on the seminar circuit, I wanted everybody to turn into technicians, and I used to proselytize. But I learned as a matter of suddenly dawned upon me, go, wait a second. I'm like Dr. Frankenstein. If everybody is using the same methodology,
right,
sell up bad stocks too.
That's right. And then you got to wait till, I tell people all the time, they go, well, if everybody does what you do, then it'll stop. It won't work anymore. I said, yes, but then what'll happen is everybody will stop using it because it doesn't work, and then it'll work again. So
history repeating over and over again, and it's true. So that's a fact. This is why I've learned we don't really have to worry about everybody following, because it's funny. Again, I no longer do the seminar deal, but when I used to talk on the seminar circuit, they would say, oh boy, the fundamentals are so important, this and that. And it's like, like you say, if everybody followed it, it would no longer work. But we don't have to worry about that, because I've seen it over and over again. The fundamentalists can be wrong 10 times in a row, and people will still follow them and say, the market is wrong. Okay, forget the market's never wrong. We're wrong. Okay, well, we're not in gear with the market. But what I find interesting, people don't believe, or most people aren't open to technical analysis. So if they try it and one stock doesn't work, I knew it's just Nancy Reagan voodoo. The bottom line is,
right.
don't have to worry about it because people will always follow. The majority of people will always follow. Yes, what is in the Wall Street Journal, and hey, the market just didn't follow that good news. It doesn't matter how many times they're wrong, so that's fine.
Yeah. Well, I often tell people, I say, look, imagine if I just took you and we went to McDonald's and I said, hey, manage the place or run the fryolator. I wouldn't even know how to turn it on. Right. And that's a pretty basic job. Right. But I would have to learn it. And I would have to learn the process. And that's, making fries at McDonald's. But people think they can open a trading account. And next thing you know, they're a trader. And they have such an unrealistic expectation of how hard it is and how long it's going to take and how many rules that they need to use. And that discipline, they just don't have the discipline in the first place. So it's just like you just said, you don't have to worry. Everybody's not going to do this. Right.
100%, and I always say, that everybody, the same way that everybody who picks up a paintbrush isn't Picasso, everybody who looks at a chart isn't the same level. I can teach people mechanically what's good and what's bad, but as we said earlier in this interview, there's a certain gestalt, a certain feeling that you get, and that takes time to really be inculcated into a person.
Yeah, I agree. I say you can put a 5-iron in your hands, but it doesn't make you Tiger Woods. So just because you're using the same clubs. But some people think that they buy the best clubs and think they're. So anyway,
history, but I read an interview with Mark, and I know it was the same for me. Where I had to pay my dues. I think part of the tuition is you start out losing money in the market, and this is what to me separates the winners from losers. The losers keep doing the same thing over and over again, and they blame their broker or somebody else for not winning. But if you're really a good market player and you keep track and you say, oh, that didn't work, what did I learn from that? That's actually part of your tuition. And I always say, when I used to be on the seminar circuit, I'd say, when we win, which was nice, that just really gratifies your ego. If you really learned from an error and you say, well, I'm not going to do that anymore, you've just had a valuable experience. And this is something that I think Mark had an advantage over me. When I read one of his interviews, I saw that he didn't go on to higher education and all that. My negative was that I did, and I got a degree in economics and all this nonsense. And I remember when I used to do a whole lot of interviews in the early 80s, I don't remember who it was, one of the guys is interviewing me, and he said, Stan, what did you have to learn to do to be successful in the market? And he thought I was being facetious. And I said, put my economics degree on the side and forget everything I was taught in college. You know what? And he's like, ha, ha, ha. But it's really the truth. And that's why I won't say who, but I have a lot of great clients. A lot of them have the degrees from Wharton and Harvard. And I have a bigger problem with them than I do because they've been brainwashed in many cases than guys who are really simply pragmatic.
Yeah, and you can be too smart and overthink this stuff and dig in. When you have that education, a little bit too much, and you think you got the answers. You dig in with these positions, and you stay in there, and the fundamentals are good, and you're buying them when they're in stage 4, and next thing you know, you're down 50-60%, and you're underwater. And I it is somewhat of a blessing that maybe that I wasn't highly educated and didn't get that. That kind of ego, at least from an educational standpoint. But yeah, we hear that all the time. So I wanted to just go back a little bit. When I first, learned about you, when I first met you, you were publishing what was called the Professional Tape Reader. It was a newsletter. And what I liked about that newsletter was that you ranked how many stocks are in stage 1, stage 2, stage 3, and stage 4. And it was a nice, if you want to call it, I call them readings. I don't like the word indicator, but it was a nice indicator or reading of the market to gauge if you had a lot of stocks in a stage 2 uptrend, you had a healthier market than, of course, if you had a lot of stocks in a stage 4 downtrend. So I'm just curious, your take on that, and if you've continued to use that by looking at those, because right now with my trend templates in MarketSmith, you can bring them up and say, oh, wow, there's 900 stocks in stage 2 uptrend, but I've seen where there's only 100, and that's when the market was not too good. I didn't want to be involved in the market. Are you still using that type of analysis?
Absolutely. I'm telling you, you run a great interview. The bottom line is after having the professional tape reader from the early 90s, we retired it in 2000, and I have what I call Global Trend Alert, which is an institutional service. We also have some high dollar individuals in there. I still use the same concepts, but now we've refined it to an even greater degree. And yes, I know I'm sure you guys see this because I know what good work you do. Most people don't realize, and this is why I say in this market, they don't realize that termites are actually at work beneath the market surface. Don't make me a bear. I'm not a bear. But there's a reason why we gave a buy signal back in April of 2020 where, hey, we came out of that big semi-crash and the market got better and better, Now, after 18 months of having a long-term, forget the short-term moves, a long-term bull call, about 3 or 4 weeks ago, we lowered the long-term rating from long-term bullish to neutral. And this dovetails perfectly, Bob, what you said. Well, and I say, don't ask me about the market. I get called day long. What do you think about the market? I say, forget about the market. Right now, this is one of the most fractured tapes that I've seen in my 50 plus years of market playing. Now, if you go back, just the numbers that you were talking about, if you go back to April of this year, April of 2021, I have what I call my secondary survey, my S&P survey. The S&P survey was just the 500 S&P stocks. At that point in April, we had 91% of all stocks in the S&P were technically healthy in stages 1 and 2. Those are the good guys. You could. That's why they say don't confuse brains in a bull market. You could have thrown a dart. It was hard to be wrong. At that time, the secondary survey, which earlier had been 93%, had declined into the 80s, but was still very good. Today, it's hard to believe, but you're close to a new all-time high in the market, and we've got on the S&P survey, it's about 47% favorable. That means more than 50% of the stocks are already technically negative. The secondary survey is about 38% favorable. That's incredible. More than 6 out of 10 stocks in the secondary area are technically negative. This is why, to me, I think it's the ideal. 2 things come out of this. It's the ideal hedge market. Everybody should treat their own account as a hedge fund, buying some good stuff, shorting some negative stuff, and we could do very well. And the second thing that it's telling us is, you know what? We're getting later in the game. I never bet on firsts. And if it doesn't turn out to eventually bite us, which I'm not saying it's going to be today, but if it doesn't eventually bite us, this will be the first time that I've seen this kind of termites under the market, technical deterioration, eventually not leading to a problem. So we're not there yet. But right now, you have to be very, very selective. And a couple of months from now, I wouldn't be surprised if we run into trouble. We're not there yet.
Yeah, I've been saying the same thing for a while. What I do is I look at the NASDAQ and I look at the percentage of stocks above the 200-day versus where the NASDAQ is in relation to its 200-day. And what I found, just like you just said, when we're at new highs and you're far away from the 200-day, but the percentage of stocks above their 200-day is below 50%, it's usually ominous. I've never seen the market survive that. And lately, not just around this time, it's been about 35%. So I'm seeing the exact same thing that you're saying. And I've been saying the same thing, that I just haven't seen this work out for very long, subsequent to that condition. But so, sometimes it does take some time. And
you're right. And I love rapping with you. You're totally right. And this is what I'm sure you've seen too. People don't understand bottoms are different than tops. And again, we're talking historically, there's always the one exception. But at a bottom, like when we turned positive in April of 2020, it was more of a simultaneous affair where almost all the stocks had a climax bottom, some better than others, but you move quickly into a more favorable phase. But if you go back and study history, most people don't know tops are a slow evolution. You lose A and then B and then C group by group. So that's how you get into trouble. And I think we're going through that stage now, but it could last for several more months. Another interesting thing, you guys have done great work, so you probably know it. If you go back to 1929, when everybody talks about, oh my God, there was that October 29 crash, the advanced decline line had topped out so before that. before that top, so many stocks were already negative. If you go back and study the charts, it was another case of where less and less Indians were following the chief up the mountain. And then, boom, it all crashed. So don't get me wrong. I'm not calling for 1929 here, but I'm telling you the negative evolutionary process has started. And this is why you have to be on top of your game here.
Yeah. And the lesson is that, if you go back and you look at crashes, there's no crash that happens off the absolute high. There's not one ever. The market sells off first, and you usually pick it up. Even if you don't pick it up in individual stocks, you'll see lots of distribution in the averages, but usually you get the stocks will break down ahead of time. And they're really sort of those are my canaries in the coal mine, if you will. And you're obviously the exact same way. So by looking at all this, you really get a good feel. And again, you're getting a feel for what's going on beneath. I talk about it, beneath the ice or beneath the surface of the water. I like the termites, though. I'm going to use that. The termites they're eating away, and then all of a sudden the house just comes down. You realize how you don't see what's going on under there. All that erosion.
I feel like we're brothers with another mother, because so often the canary in the coal mine, and I think like the Russell 2000, the RUT, is sort of the canary in the coal mine here. If you take a look, even when you made all those new all-time highs the last couple of months, and the last one was early September, I think September 2nd or 3rd for the S&P, the Russell didn't come close. The Russell hasn't made a new high for a heck of a long time. And that's, again, when we look back, and it doesn't have to be tonight or tomorrow, when you look back and you study history, just like happened in 1929, it's going to be, oh yeah, there it was again. It was sticking out, because when we're in the moment, everybody's looking like in this market from 2 o'clock to 4 o'clock, you can have a bull and bear move. That's what everybody's concentrating on. But that's why I write all the time, separate your ones on the Richter scale, which is the short-term, less important stuff, from the tens on the Richter scale, which is the important longer term. Longer term, we're rolling here. But that doesn't mean that, I know you guys are great. If you really focus on your stuff, as long as you keep one eye on the exit door, we can still make some money. But I want to play this hedge, because I see good stuff, I see bad stuff here.
So let me ask you, not market specific or stock specific, but generally speaking, I always get this question at the end of an interview. What's your advice for traders? I mean, even talking to relatively new traders. I know people think that they're a seasoned trader nowadays. They've been in the market for 3 or 4 years, but you and I have learned it takes a lot longer than that, right?
Some who've been 3 or 4 days, they think they're seasoned traders. Get around and say a lot of these Robin Hoods and these kids, this is, again, they're going to have to learn. The market has a way of always correcting excesses, and we saw that with the meme stocks and all that. People think it's all so easy. It's not so easy. And this is why I'm a big sports fan, so I always talk in terms of sports analogy. I like the fat pitches down the heart of the plate. I see so many people swinging at pitches that are way off the plate here, that are out of the strike zone. And really, and I know you guys are very disciplined. You got to be disciplined here and focus on what's really, really good. And it's becoming more and more important to be focused here, because as I wrote recently, and from your numbers, if you're not disciplined right now, it's so easy to step into a pothole.
Yeah, you're not kidding. Stan, you were, when I first met you, I felt like you were a rock star, and now it's 30 years later or whatever it is, and I still feel like you're a rock star. It's awesome. Yeah, man, it is really awesome and an honor to be talking with you today. It's just I haven't spoke with you in over 30 years, and it's like it was just last week. So it's really, really awesome.
Bob, there are certain eternal truths, and I know you guys have discovered it. We can all change it slightly, but there are really simple truths, and that's why when you go back to the professional tape reader, which you spoke about earlier, at the top of each issue of the tape reader, I had a simple phrase that said, "The tape tells all." And that wasn't just a glittering generality, it's the darn truth. And as you also said, because you're on top of your game, they make it so much harder. And that's why when I used to be on the seminar circuit, I would use that KISS, keep it simple, stupid thing. I listened to so many people and they cloud their minds with so many things instead of just saying, what is the good probability? That's all. We're dealing in probabilities. Only the liars are always right. But I've said this before, if you have good discipline, you can make a lot of money being right less than 50% of the time. And I know you guys have discovered that. But I think that we're good enough that we can be right 75% of the time. And at the end of the year, all we need is a creative accountant.
So now, everyone, as you're listening to this, you can probably start to put the pieces together and see where my lineage came from. And when you hear these things, you can see where what I'm saying is resonating, and we're so on the same page. So again, I stood on the shoulder of giants, and you're going to be standing on the shoulder of all of us, and that's the whole idea here. This particular year in this Master Trader program, I did something unique where bringing you on, Stan, Tom Basso, Larry Height, who was a hero to me, David Ryan, and then Mark Ritchie, who you probably don't know, but he's sort of like the new age market wizard. He's someone who came to my seminar 10 years ago, and he's turned into a superstar. So this is just, I'm just so honored. I want to thank you for taking the time to do this. Really appreciate it. Thanks a lot. Thank you very much, Dan.
My pleasure.